Welcome to the Mayor of Money podcast with former Burlington Mayor Rick Goldring of Goldring Financial Leadership. In this podcast, we provide successful business owners, including doctors and dentists, with insights to minimize tax and risk while maximizing retirement income and future legacy. Join us for this journey as Rick draws from years of experience and guest experts, including successful entrepreneurs, to provide unique strategies and approaches to estate and financial planning matters, as well as business in general. Now, on to the show.
Well, welcome to the Federal Budget 2022 special edition of the Mayor of Money podcast. And my special guest today is Joël Campagna, a tax partner with MNP in Waterloo, Ontario. And Joël, a big welcome to the Mayor of Money podcast series. And we appreciate you taking time to share your perspective and wisdom with regard to the 2022 federal budget. Thrilled to have you here.
Thanks, Rick. And I'm thrilled to be here. I really appreciate the opportunity to chat with you and your viewers and listeners.
So on April the 7th, 2022, Finance Minister Chrystia Freeland presented the 2022 federal budget. And if there was one theme you had to pick out of it, my view is it would be housing. Can you share now one of the big issues is the fact there is a housing crisis across the country. The government has defined that we need to build 3.5 million new homes in the next 10 years in Canada to handle the housing shortage, and recognizing the 450,000 or so new people coming to Canada each and every year. So the government's taken particular action to help support home ownership. And Joël, can you give us an outline as to some of the actions that the government is taking that they announced in the budget?
Definitely, Rick, thanks. And so I guess the one thing, the housing shortage, I don't know that the budget necessarily does anything to clear the housing shortage, right? Because it's not really doing anything on the supply side of the equation. What we're doing is maybe making the demand side have a little bit more ease in coming up with funds to buy housing. For example, I think that the one new thing that they introduced was the tax-free first home savings account, which is really very interesting, right? It's for individuals that are over 18 years of age. They'll now have the ability to contribute $8,000 a year into this special savings account, similar to an RRSP or a TFSA, because the money is going to grow tax deferred inside this account. But the interesting thing here that takes it away from, let's say, how an RRSP works or a TFSA works is with the TFSA, when I contribute money into my tax-free savings account, I don't get a tax deduction. With this new vehicle, I'm going to get a tax deduction when I contribute money into the FSHA. So great, I get some tax savings there. Normally, when I pull money out of my RRSP, I'm taxable on that money. So the difference between this new vehicle and RRSPs is on a withdrawal out of this vehicle to acquire an eligible home, no taxation. So I get a tax deduction on the way in, I get tax-free growth while the money's in there, and I can pull the money out tax-free to buy a home. Some caveats there is I am limited to $8,000 per year, and my maximum lifetime contribution to this plan is $40,000. And it's not quite necessarily the $8,000 I mentioned. It's not really a use it or lose it like it sounds. So in year one, if I only contribute $5,000, year two, I can only contribute $8,000, but remember, I still have that $40,000 cap. So I am limited at $8,000 per year. So I don't lose the $3,000 that I didn't contribute in year one. It just means that, you know what, rather than contributing $8,000 a year for 5 years, maybe I'm $5,000, $8,000 for a bunch of years, and my last year will be $3,000 to get up to my $40,000. The money grows in there, like I say, tax-free. Down the road, to the extent I do not buy an eligible home within 15 years of starting the plan, then I have to pull the money out. The positive of it is I can actually roll the money to my RRSP. I don't actually have to pull it out into a taxable environment right away. And moving that to my RRSP does not reduce my RRSP contribution. So I can get it into the RRSP tax-free. Now, the downside there, of course, is in the future, when I do take money out of my RRSP, now that money will be taxable in that. But I'm no worse off because I got a tax deduction up front, similar to an RRSP, and now I'm getting taxation at the back end. Lastly, I'll say they did bring in a provision that, you know what, if I want to move money from my existing RRSP today to this home savings account, I can do that also. So I could move $8,000 a year to get my $40,000 into this account. And then when I pull it out of that account, it'll be tax-free to buy a home. But bear in mind, I do not get back that contribution room. Once I pull that money out of my RSP, I can't put it back into an RSP. Unlike a TFSA, where when I take money out of my TFSA, I get that deposit room back in the following year.
Right.
So say a very interesting plan. Again, does $40,000 do a lot in today's home market to buy a house? Not necessarily, but at least it is giving people another incentive to kind of move money, set money aside to help with that purchase of a house.
So if you walk into your bank today or talk to your financial advisor, I don't believe that you can actually set up that plan today. So the plan is going to start in 2023.
Correct. 2023. So they're giving financial institutions time to set up the infrastructure, to set up the reporting that's going to be required for these things, the tracking and that. So again, getting their computer systems up to speed and that to be able to actually administer this new animal that the government's created.
But you're right, though. If you haven't, if you're in a position where you actually qualify to make a contribution and set up a plan, there's very little downside in going ahead and setting up a plan.
Exactly.
Yeah. And if your intent is to buy a home, it's going to make it a little bit easier.
That's right. Also in the home buying, so they've doubled the first-time home buyer's tax credit. So the tax credit used to be $750. It is now doubled to $1,500. So it's again the tax. So rather than being 15% of 5,000, now it's going to be 15% of 10,000, and that starts actually this year.
So with the tax deduction you get of that up to $40,000 contribution into the tax-free first home savings account, as well as the first-time home buyer's credit, that's two ways that the government is helping you have more money available at the time you need a down payment.
Correct. So making it easier to acquire that house. And again, it is for first-time home buyers. You cannot have owned a home yourself, neither you nor your spouse, in the previous 5 years.
Now, somebody asked me recently, and I'm not sure of the answer yet, but when you have somebody, if you have a husband and wife or whatever, two partners, life partners, and one has already owned the home and one hasn't, how under those circumstances is a first home savings account available? Is it available to the one that's never owned a home, but not to the one that has owned a home?
My understanding is that both individuals would have to have neither one of the individuals would have to have owned a home previously. So that's going to potentially throw us offside for that.
But in any event, it's a good tool. It's good progress, creating opportunities and using some government money to help towards a down payment. Now, one of the revenue raising areas that they're trying to affect, are trying to get some money as well as affect the price of homes potentially, is on the anti-flipping. So can you describe with regard to what the rules are now and what the budget proposes the rules will be?
So right now, there is no real prescribed rule per se. If you sell a home that was your principal residence, so you actually lived in the home, and that you can avail yourself of the principal residence exemption, which means that on the sale of that home, you pay no tax. Now, you do have to report the disposition, and that you actually have to report it in your tax return that you did dispose of a principal residence, but there's no tax. So there is no real set de minimis rule that says, okay, you have to have lived in the home this long. And I think that's where maybe some of the abuse has been coming into play then is, someone will buy a home, live in it for a month or so and say that, okay, that was my principal residence, turn around and sell it, not really ever intending to live in the home long term. And now, because of this insane housing market we've had over the last several years, there is that ability, you buy and resell quickly, make a profit and not have to pay any tax on that profit. Now, if someone was doing that on a recurring basis, arguably they're in the business of flipping houses, and you wouldn't necessarily need this new rule to capture that. You'd say, well, that's considered an adventure or concern in the nature of trade, and therefore that would be fully taxable. This new rule says, look, if you sell a house within a year of acquisition, we're going to treat that as regular business income. and 100% taxable. So not only am I not getting the principal residence exemption, which would cause it to be tax-free, or even saying, well, at worst case scenario, maybe treat it as a capital gain, which would only be 50% taxable. This is saying you sell that within a year, we're going to tax 100% of your profit at whatever your marginal tax rate is. Now, of course, there are some outs for significant life events, death, separation, right? Anything like the significant life event that causes to say, oh, you know what, I actually had to dispose of that. My intention was to live in that house for a long period of time, but I had a significant life event that happened that caused me to have to sell my home. And like I say, death, disability, separation, maybe a change of employment, right? I suddenly get transferred across the country, which I wasn't expecting. So again, that could cause me to have a short-term ownership window there. And again, this rule wouldn't be designed to catch that type of situation.
But you're right. I mean, the big difference is when you compare principal residence where there's no tax on the in that scenario to now it's all taxable, the particular gain. That's a big change from the current regime.
Definitely, and that can be significant, especially when you look at how quickly house prices have accelerated, right? And that the gains that, you know, people that have bought a house even just a couple months ago now are sitting on a couple $100,000 profit already in some situations.
Yeah, no, it is significant. Now, another area that the government's trying to help out in with regard to control the pricing of housing is trying to maybe minimize the players in the housing market, and that is putting some restrictions on foreign buyers. Can you enlighten us on that aspect?
I don't have a lot of details on that, Rick. I apologize in that, but I know they are trying to limit the fact that, you know, if you're not a Canadian citizen, that your ability to buy homes, and I apologize whether or not I think the rule is over the next 2 years that they're going to cap the ability for foreign buyers to actually buy into that Canadian housing market, which theoretically should kind of reduce the demand on Canadian housing. Now, if someone is moving to Canada, maybe there's an exemption there, or, you know, you're a Canadian citizen that just happens to be living outside of Canada right now, you can still continue to own Canadian real estate.
Okay, so one of the challenges in society today is this aging baby boom we have. All those people born from after the war to the early 1960s, and as time goes on, there's going to be need to downsize, need to transition in housing, and you really do want to encourage people to leave their traditional family home and have some other accommodation. And there's also maybe the need for these aging baby boomers, self-included. We want to live with our kids, but separately. So now the government has come up with what's called a multi-generational home renovation tax credit, which will provide up to $7,500 in support for constructing a secondary suite. And while I was mayor in Burlington, we attempted to encourage secondary suites. And I must say, I don't think we got very far. So it'll be interesting to see whether or not this particular multi-generational home revenue or home renovation tax credit will have an impact. Thoughts, comments, Joël?
Yeah, no, I think it's very interesting, right? I think in North America, historically, we have not had multi-generations living in the same home, right? It doesn't seem to be really a North American phenomenon historically, but as we do have immigration, and it is definitely prevalent in other nationalities, and now so there's going to be an incentive there to actually create that quote unquote granny suite in the house, that self-contained unit. It does have to have its own living accommodations, bedroom, sleeping accommodations, cooking accommodations. So really that self-contained unit, whether it's in the house or looking at, you know, is it a separate building on the property itself, but that self-contained unit to have that multi-generation in there. It does apply, like you mentioned, Rick, it's a 15% credit on expenses up to $50,000. And that, so if we run the math on that, it's worth about $7,500 tax savings, Beverly. And it applies for 2023 and onwards. And that's one of the things in the budget that I did notice that you probably came across. A lot of these new things that they're bringing about are for in the future, right? Where these things are going to kick in 2023, or some of the commentary is, you know, we're looking at these things. We hope to release something in our fall economic statement. So that's where kind of when we look at this, we don't have all the answers, unfortunately, because they are doing analysis and studies on some of these things. Other rules are a little bit more finite, and it's okay, here's a hard start date that we're looking at. But again, I think this is great. It's, you know what, like you mentioned, you know, multi-generational, we've got an aging economy. Who better than to take care of our family than family members themselves? We have a family member right now that's in a long-term care facility. And you know what, ideally, if as a family, if we had the ability to have them close by and have the care that they needed, that would be ideal in that. But unfortunately, so this can work great on one hand, but I think it depends on the individual situation, right? If they're needing full-time nursing care, and that this may not be the answer, or maybe the answer and then is, you know what, hiring out independent nursing resources to come into your home, and that so you can have your family still in your home, your parents or grandparents, where that is, can still be comfortable in a comfortable, friendly environment and have those resources come into them.
But housing certainly was a focus of the budget. And one of the things they raised is they're going to start studying the fact that housing has become a significant asset class. And they're looking at larger corporations that own many different residential properties and single family homes. And I guess they're concerned about the impact on the price of housing from these corporate structures. And they're going to take a look at it. What do you surmise could they conclude from this particular issue and this particular investigation? Will that result in some action with regard to minimizing the profits of these companies?
Well, you know, that one I do find interesting, Rick, because when you say, well, I'm going to limit who can buy these in corporations, but now are we limiting again the supply side of the equation, right? If we need more homes and that more single family dwellings, whether it's apartment buildings or actually single family detached homes, if we limit now who can own those, are we going to limit who's going to be willing to actually invest in building these extra homes that we do need, right? I don't know that it necessarily cures the supply side of the equation. Does it say, okay, are we able to keep prices down? Now, I know there's been a lot of discussion on the rental side of the market, right? Where these corporations come in and buy these rental units, refurbish them, and then increase the rent. Well, how's that any different than any landlord would do? If I invested my capital to improve something, its value to the marketplace should be higher. And I should be able to charge more. I guess maybe is the issue how quickly you do that. And I guess query now, what's the impact going to be on some of the real estate investment trusts that are out there, right? There's significant investment vehicles out there that invest in apartments and such like that.
And the people that are investing are contributing to improving the rental stock that's out there.
Exactly. Taking maybe a building that maybe wasn't in great shape before and now bringing it up, improving it. And now maybe a neighborhood that was due for kind of regeneration or whatever. And now you are bringing things up. So yeah, hard to say. I'm not really sure how that's going to play out. Can you say back in the kind of going way back in what is it, the 70s, when they had these multi-unit residential buildings and there was tax incentives to build in apartments and such like that, the MURBs they called them. Well, are we going the opposite direction here by limiting who can own these units?
Yeah, there's a big challenge with housing in general, and there's a particularly large challenge with the fact that there's not enough rental housing, purpose-built rentals in the marketplace. And there's so many people that have invested in condominium townhouse units or condominium apartment buildings, but they're not purpose-built rentals. And so you can't, as a society, you can't rely on them because people have invested in them for periods of time. They rent them out, but ultimately they do sell to maximize their profit, and they do sell to simplify their lives. But it doesn't help with having a clearly defined a number and percentage of rental units in the marketplace. And I think this is something that was missing, is that there's no real incentive to build more rental units. And you have to look at the provincial government as well as municipal government to figure out ways to do that.
Now, I wonder if maybe what they're really looking at, and it didn't come out in the documents, is looking at curbing the short-term rental market. right? Where I'm buying up a bunch of condominiums, and rather than actually renting them out to individuals in 1 year or 2 year leases, I'm keeping that for the short term market, right? Converting essentially apartments into hotels,
Yeah.
de facto hotels, and that really is taking supply out of the market.
Yeah. And more municipalities are looking at ways to try to regulate that, or try to modify how many homes can be eligible for that type of short-term rental.
Yeah, and I understand, and you would have a better grasp on this given your former employment as mayor of Burlington. I understand that it's difficult for municipalities to curb that because it's actually a provincial law that has to be changed to allow the municipality to actually bring in bylaws to do that, right?
And municipalities love to blame the province. They love to blame the province, but it is interesting. The housing issue, where the rubber hits the pavement, is at the municipal level, and the people that vote tend to be homeowners more than renters. And the people that vote don't want to see too many changes in their community, which means not too much new housing. And so there's pressure from the voters in a municipality to not grow too fast, and certainly not to have too much density with regard to big apartment buildings or tall buildings. And so that really pushes the municipal councils to minimize some of these development applications, where the federal government has come along to say, we want to encourage more of what the municipalities are pushing back on. They don't say it that way, but that's in fact what they're trying to do. So we'll see what happens with that. And one of the things in the budget too is some incentives, financial incentives from the federal government to encourage municipalities to create more housing. And we'll see how that goes.
I understand getting building permits issued quicker and those types of things, right?
Right, exactly. And sometimes when you're elected official, you like to drag these things out for political reasons, but in any event, that's just the reality of it.
So it's interesting. We had the kind of the budget bringing in all these things, trying to incentivize new home ownership, trying to incentivize credits for individuals to buy homes and that. Then yesterday, of course, we had the Bank of Canada increase the bank rate by 50 basis points, which of course is going to make it harder for some individuals now to buy homes, right? So we've got obviously fiscal policy and taxation policies, or different policies here that are impacting and going to have an impact on the housing market.
Yes, and it'd be interesting to really measure outcomes. And I don't think that happens enough in government, where you actually attempt to measure the outcome of what you've implemented, of the measures you've taken, to really see if there's any particular impact. And sometimes when there is an impact, it can't be attributable to the action that was taken. It's really because of other reasons. But this is, government does the best it can with, I guess, the tools that's been given to them in the political environment that they operate in, and, recognizing that all governments want to get reelected. Now,
okay, and we all have the benefit of hindsight, right? So it's being that armchair quarterback. Everybody's doing the best they can with the information that they have at the time, and
it is easy to criticize. It is very easy to criticize. So one of the interesting items is the retroactive tax, and there's more tax going forward, but the retroactive tax on banks and life insurance companies, because they did so well, they operated so well during the pandemic, they made too much money, so we got to go back into 2021 and grab some money from them. And I can't think of any other sector where they could do that and get away with that, because if they tried to do it in any other sector, like the technology sector or the resource sector or whatever, there would be a significant pushback. But because not everybody, but they say everybody hates the banks and big life insurance companies, they were able to get away with it.
Yeah, interesting. I was reading that. So yeah, it's an extra 15% tax on their profits above $1 billion that they earned in 2021. So that's, as a shareholder of a bank or insurance company, that's a little concerning when all of a sudden what you thought were the reported after-tax profits of the investment that you had made. Now all of a sudden there's this retroactive tax that's going to claw back some of that after-tax profit. So there's got that one aspect, and you're right. Generally, we don't see retroactive taxation, right? Generally, taxation is done prospectively in that, so that we're all playing by the same rule sheet when we actually did the planning that we did with versus all of a sudden the rules changing after the fact. Now on a go-forward basis, so we've got this retroactive tax, but also on a go-forward basis, the banks and insurance companies are going to be subject to 1.5% higher tax rate than other businesses. And so if you look at your normal business in Ontario, for example, an active business that has taxable income of above $500,000, they're only paying a 26% tax rate. Well, now the banks and insurance companies are going to be paying 27.5% instead of the 26. You can argue if that's fair or not.
You have some history working with one of the major life insurance companies in Canada, and so you know that sector well. What do you expect the impact will be, or will there be any impact, do you think, to the average consumer, somebody who purchases insurance products from one of the insurance companies, or somebody who has their money with a bank or borrows money from a bank? Do you see any impact to consumers?
Well, I think in any time a business has its cost structure increased on it and it wants to maintain a certain level of return on equity or return on capital, generally what would happen is where prices will increase somehow so that I can maintain that return for my shareholders. So will we see an increase in fees down the road? Possibly. Now, with interest rates going up, that's just going to increase bank profits potentially as the spread goes up, right? As now we're re-lending money out, the mortgage rates are going up, so maybe the spreads that they're earning are increasing, maybe able to recoup that. But again, that extra profit is going to be subject to higher tax. Looking at what are our shareholders looking for, right? What's our competition looking for? We can't necessarily look at Canada in isolation, right? A lot of our financial institutions are multinational, and right, a lot of our Canadian financial institutions do own entities in the U.S. And then when we're looking at getting investors from around the world and compare, if someone's looking at investing in Canada versus investing somewhere else, well, I have to look at what is that return on equity from that financial institution in Canada versus that one maybe that I can invest in somewhere else. So generally, yeah, the CEOs of these companies are definitely going to have some things to think about, right? Because also, you know, who's going to be the first mover?
Yeah.
Because
I really do think this is just a political play. I'm not sure who they're appeasing, but you know, you think about it, you're going after companies that Canadians, like millions of Canadians, use the services of and use the products of on a regular basis. So who are you really going after when you go after the banks and the insurance companies? We'll have to wait and see what the impact will be.
Yes.
Quickly, we have an alternative minimum tax in Canada. We've had it since 1986, and I think that was, you know, a reason because there was some perception that there were people getting away with a lot of tax savings or weren't paying any tax. So they came up with this alternative minimum tax, and now they're going to review it. Now they're going to review the alternative minimum tax. What do you see coming out of there? What sort of process are they going to go through to determine whether the current alternative minimum tax structure or regime should stay in place or whether it should change?
You know what, like anything, I think, you know what, I think our whole tax system is probably due for an overhaul, right? We haven't had significant tax reform for quite some time. So kind of looking at things more holistically probably makes sense. With this particular item, you're right, hasn't been looked at since 1986. And then the whole idea of an alternative minimum tax is say, look, if I have net income, but I'm able to have preferential tax deductions that actually takes I've actually earned money, but I've got these preferential tax deductions that reduce my taxable income to a low amount, we want to make sure you're paying at least a minimum amount of tax. That tax can be carried forward as a credit to future years. So it's not like you're going to lose that money, but we're just making sure you pay a minimum amount of tax. Should that be looked at? Probably. Maybe is that minimum amount enough in today's world? Hard to say, right? We're looking at something that was designed 36 years ago or came into play 36 years ago. It's probably due for reform. Some of the types of preferential deductions that cause you to get into alternative minimum tax are one of the items, and one of the other items that was in the budget actually is like flow through shares, right? Where I get the tax deductions from oil and gas exploration can be claimed by me as an individual on my personal tax return if I've invested in these types of vehicles. Now, notwithstanding the fact that the one thing that the budget is looking at doing is you'll no longer be able to get those tax deductions on flow-through shares and invest in oil and gas. They're actually hoping to move that to actually mineral exploration, right? And helping for looking for electric vehicles and stuff like that. So shifting the economy away from kind of oil and gas. But if I had invested in those oil and gas flow throughs, was able to claim some significant deductions on my tax return, I could have had earned income, but no taxable income. So that's what got me into this alternative minimum tax. Or one of the avenues and one of the things that they did not shut down, but where I claim the capital gains exemption, right? And there's always been speculation on whether or not the capital gains exemption will go away or not. And that's for on the sale of shares of a private corporation that is truly an active business. The capital gains exemption is just over $900,000. So if I can actually sell shares of my company, $900,000 worth, and not pay any tax on that. Well, let's say that's the only income that I had that year. So I had a $900,000 capital gain, but I sheltered it with the capital gains exemption. Well, that would kick me into alternative minimum tax also, because I had income, but I had this preferential deduction in that. So kind of probably makes sense for them to look at the scheme of alternative minimum tax. Is it working the way it should? And that, again, they're going to look at it. There's going to be consultations, and we'll see something probably later this fall on that. With the capital gains, I say one of the things that they did not shut down in the planning was, and you've probably heard this terminology from last year, was the private members bill, what was introduced as Bill C-208, where in the past, if I sold my shares of a private company to an arm's length person, and it could be an arm's length corporation, I was able to claim the capital gains exemption. However, if I wanted to sell my operating company, the shares of my operating company, to my adult child, to their holding company, because wanted the business to stay within the family and continue on, that sale would be treated as a dividend instead.
Right.
And I wouldn't be able to claim the capital gains exemption. Well, Bill C-208 allows for the claiming of the capital gains exemption on a sale from parent to child, an intergenerational share, where the child is truly going to continue on the business. And so we can sell it to their holding company, I should say, right? We could always sell it to them directly, and that now they'd be using their own personal money to buy the company. But now selling to their holdco, we can do. And we were looking at potentially that there was going to be some, initially in last November, they were supposed to review this because this private members bill was introduced last summer in July of 2021. We were expecting changes in the fall of 2021. Nothing happened. We were expecting changes in this budget. Nothing happened yet. And now we're waiting for, again, the fall economic statement where there are some problems with the rule. Like conceptually, it makes sense. I should be able to sell my business to my child's holding company and a true exit where I'm looking at transferring that business to them. And that there's some other wrinkles in there that need to be tweaked, that it does make sense to tweak. And again, we're waiting to hear how that's going to play out.
Yeah, so one of the things they didn't touch was the capital gains exemption. I think people were relieved about that, and they didn't really change the rates except for banks and insurance companies. Correct.
Yeah, there was a lot of speculation that the capital gains inclusion rate may increase from the current 50% up to, back to 2/3 or even 75%. Right? If you look in the 1990s, we actually had a 75% inclusion rate and actually a 2/3 inclusion rate for a time period. In actually 2000, right at kind of towards the tail end of the dot-com boom, we actually had 3 capital gains inclusion rates that year. 75 dropped down to 2/3, dropped down to 50%. Yeah. It wasn't fun doing tax returns that year.
No, it wouldn't have been good fun at all. But in any event, there's lots of relief, as much as you always are concerned when a budget is going to be presented about what the impact will be on business and individuals. And the impact wasn't too bad. In fact, there was opportunities on the housing side for people to invest in a first-time home. That there is some incentive. So all in all, it was a budget that did not create overly an over amount of concern, or a great amount of concern that people would have to take action with their accountants right now. There's things that people want to know about, but they need to respond to, as opposed to be panicked about.
Yeah, I'd say the only thing that was kind of shut down, we'll say, is and you probably saw some articles recently in the Globe and Mail and stuff like this about the non-CCPC planning, right? Where people would move their investment corporation offshore, and they therefore were able to benefit from lower tax rate on investment income earned inside the corporation that was still deemed to be resident of Canada for tax purposes.
Right.
And that was definitely shut down. But on the positive side, we didn't see any wealth taxes that there had been speculation on. Yeah. No estate taxes that there had been some speculation on, right? So thankfully there were no new taxes that way.
Well, listen, I want to say thank you very much to Joël Campagna, the tax partner for Waterloo, Ontario office of MNP. Joël, thank you very much for enlightening us on your perspective and experience with regard to the 2022 federal budget. And we'll have to have you on again when we get another economic statement and when we have another budget, because are you of the view, last question for you, are you of the view that our debt is where it should be, which is over $1 trillion as a country, as a federal government? Our debt is where it should be with regard to the percentage of net debt to GDP, or should the debt be lowered? Like, do we have a concern that people that have all the money need to be concerned about future tax implications on subsequent budgets?
I guess that's a tough one, Rick, because I think that there's much smarter people out there than me that would say, what's the right ratio of that of debt to GDP, and that. I know I will say my daughter, who's in high school and 17, has trouble grasping how this works, right? Where is all this money coming from? And she even comments, and then she doesn't have an economics background. I think she's even saying, does money really have any value if you can just keep printing money? In that. So what's the right answer? Gosh, I don't know. Like I said, there's much smarter people out there than me that study this on a regular basis. Some very smart economists out there. I know Frances Donald from Manulife would probably have some great commentary on that, what she thinks is kind of the right ratio and where she thinks the economy is going, and are they doing the right thing?
Yeah. Well, listen, thanks again, Joël, for being on the Mayor of Money podcast. Thank you all for tuning in and listening or watching the Mayor of Money. And we'll see you next time for the next episode of the Mayor of Money podcast. Remember, we're still in a pandemic. Remember to stay positive and test negative. Thanks for tuning in.
Thank you for listening to the Mayor of Money podcast. Click the subscribe button below to be notified when new episodes become available. If you'd like to have a one-on-one discussion with Rick or have an idea for a particular guest or topic, contact him at rick@rickgoldring.com. See you next time on the Mayor of Money podcast.